I'm Peter White. Welcome to the Inside Network. Welcome to the Inside Network and another edition of INDepth. I'm Peter White, and my guest today is Simon Shields, co-founder of Monash Investors. Simon, you're the first manager to undertake this restructure from an LIC to an exchange-traded managed fund. Can you talk us through the thinking?
Most LICs are trading at considerable discounts at the moment. It wasn't always this way, but it seems to have become a permanent feature of how the vast majority of LICs trade. As a fund manager providing a service to clients to invest in a strategy, I'm not particularly interested in having my clients being forced to sell out at a discount to the investment products that we're providing for them. But there seemed no other way to fix the discount. We tried all sorts of things. We tried share buybacks, both on market and off market. We increased the dividend yield. We increased the frequency of the NTA disclosures. We increased our communications. None of these things worked. And despite excellent performance, we still had a discount. So we really racked our brains as to how we could fix this, and ultimately came up with the modern exchange-traded managed fund structure, which is a unit trust that trades at NAV because a market maker is prepared to buy and sell around the NAV on market, and the fund stands behind the market maker so that when the market maker takes units, we stand behind that and buy them off him, and vice versa.
So the ticker of the new fund, it's the Monash Absolute Active Trust, and the new ticker is MAAT. The old ticker was MA1.
That's right, Peter. So the new ticker is MAAT, and we call it MATE.
That's very good for an Aussie equities. Why hasn't anybody else done what you've done before?
Well, there has to be somebody who's first. It has proved to be quite a difficult thing to get through the regulator as well. First of all, we had to theoretically work out how to turn a company into a trust without doing it in a very expensive way. We tried to avoid a scheme of arrangement. We worked out a way that we could do that. Notwithstanding the fact we still needed to get 75% of the shareholders to vote, we were able to take that expense out of it. The other thing, of course, was that just as we were beginning to do it, the structure of market making in Australia changed with one of the main providers withdrawing. That led to ASIC having an inquiry, which caused about a year's delay. And that wasn't the end of it. There was subsequently more work that had to be done by the ASX before ASIC would sign off. And then we had to get our solution up. And both those regulators had to look at what we were doing before they gave us a tick. And then lastly, we had to go back to the shareholders and get a tick from them too.
Well, you got more than a tick, I gather. The vote was something in excess of 99%.
It was exceptional. We had 99.98% voting for. I have never heard of any other company getting shareholders voting that strongly on a resolution.
It sounds like an Eastern Bloc number.
It does, doesn't it? Yeah.
Well, do you expect to be mimicked by other LICs who are trading underwater?
I would think so, yes. I mean, I don't see how any LIC that's trading at a sustained discount over time won't want to become an ETMF instead.
Well, can we look at the fund or the trust itself? You're long, you're short, you're benchmark unaware. Can you talk us through the thinking of how your day-to-day management works?
We wanted to get away from what traditional fund managers have become, which is basically they pick a style and they try to make small bets around the index in order to beat it. But the customers know they're buying a growth manager or a value manager. In a bull market, the growth manager should do well and the value manager should do poorly, for example. Having done both growth and value and a couple of other slightly different styles, I was just no longer interested in going up and down with the market and being stuck on the wrong side of it. We have more of an absolute approach rather than a relative approach. That means every time we make an investment, we aim to make money from that investment, not just be satisfied that our investment's going to do better than another stock that might be doing badly. So our approach is to look at the value. What we say is that we want to see at least 60% upside to the price that we think the stock should be trading at today from its current price, if the rest of the market agreed with us about the future of that company in terms of its outlook for revenue and margins and what its balance sheet is going to be like. So if we can get a payoff to 60%, and we think that should happen now if the market agreed with us, then we'll buy the stock. When it comes to shorts, we've got to see 30% downside, and then we'll short the stock. And we've got different rationales for believing that we'll see that payoff.
You say that you tend to go long rather than short. Is there a particular reason for the emphasis on long rather than short?
It's much easier to find stocks that are going to go up than to find stocks that are going to go down. And in fact, of course, some companies...
A lot of investors wouldn't agree with you there, I guess.
Well, the stock market does tend to go up over time, and many stocks just go up and up and up. And multiple times. Whereas if a stock's going to fail, the worst it can do is go down 100%, and that's all you can make from it. So when it comes to actually building positions in companies, there's generally less of a payoff that you can be confident in a stock that's going down, and as a result, a smaller position is justified than in a company that's going up, and you can see a larger payoff in. As a result, we tend to have smaller positions in the smaller in the shorts, and we also have fewer positions in the shorts. Therefore, generally, we have a long bias in the portfolio.
Do you think the average investor understands the term absolute return?
Not really, no. And I'm using it in a fairly nuanced way. Many people will think that if you're investing in an absolute return product, it only goes one way. It won't go backwards. It'll only go up. Our product's not like that at all. It can go down as well as up, but what we're doing is every time we're investing, we're looking at the absolute payoff, not a relative payoff.
Can we get stock specific for a moment? Can you talk about some of your best ideas and some of your current holdings or positions?
We've had some very good ideas from time to time, but like any portfolio, those ideas mature and we sell them out and look around for the next one. Recently, we sold out of Afterpay, which was a tremendous investment for us. We first bought Afterpay at $5, and we could see how quickly customers were buying from merchants who put Afterpay on as a feature of their online payments. And of course, all the metrics associated with online meant that Afterpay could walk around and they could show all these retailers what would happen if they put Afterpay on their website. So on the back of that, and having seen the experience of Afterpay where its bad debts were very low, we were confident enough to be able to value the outlook for Afterpay in Australia, and also that it would go overseas, at least to one market, and put that into our price assessment of Afterpay. We bought at $5, and while the stock price did go up and down over time, we recently sold the last of our shares at $153.
And what does that say about your views on the buy now, pay later sector, which seems to be flourishing, or has it expanded itself beyond reason?
No, it's still in the early days. What we do, however, is we look at the price we think the market should pay for the stock today based on what the stock's going to do in the future. And the market has got very excited about the outlook for buy now, pay later. In the case of Afterpay, we had a valuation of about $150 on the stock, and that was based on what we thought the stock was going to do as a business over the next 8 or 9 years. Once the stock price got to $150, we were getting paid for work that they hadn't even done yet. We didn't know whether they were going to do that work well or badly, and we didn't know whether our forecasts were going to be coming true or not, but we were getting paid for it as if they were. So at that point, we'd made all the money that we thought we were going to make in Afterpay, and we'd made it very quickly, and so it was time to exit that position.
Are you holding others in the sector or looking at them seriously?
We're not holding any others in the sector at the moment. We do look at them seriously. I mean, Afterpay has come back into the $90 range now, so it's well down on where we last held it, and so there is a price at which we would buy back in, looking for that 60% upside.
But beyond Afterpay in the sector, are there others like Zip or others that you've looked at? Or
it's a really tough one. When industries are in their early phases, they tend to be quite fragmented. It can be quite hard to pick winners in a situation like that. As they mature, there will be consolidation, and the winners will become more obvious with hindsight. One thing we do know, though, is typically those businesses that are number one or number two in the space are the ones that are survivors and do very well. Afterpay is certainly in that category at the moment. I'm not sure Zip will remain in that category with the likes of PayPal, for example, coming into the industry.
What about stocks that you're currently holding? What positions are you, if you can talk about them, are you quite excited about?
Well, it's not all tech. For example, we've got a stock in our portfolio at the moment called People Infrastructure. The code is PPE. It's a labour hire company. Labour hire companies are relatively boring companies typically. This has a bit of a difference. It has a platform where it's able to white label its platform for other labour hire companies. It's also growing by acquisition. And so that leads to another layer of growth in the company where it's arbitraging the price of companies in the private market while it's got a public market price multiple on it. It's also in some sectors of the labour market that's doing particularly well at the moment, such as nursing and in-home care. So you put all that together, we've got a stock that's growing at more than 20% in terms of its EPS for the next few years, compounding, and it's on a relatively modest PE. It's about 17 times is the PE. So we think that stock's got a long way to go. We've got another stock in the portfolio that is, again, in a completely different area. It's called Telix. Telix is a biotech, and it develops a drug for cancer patients that allows the doctor to image where the cancer is in the body using a nuclear medicine that shows up on the imaging scans. And it's much more precise and accurate and gives a much better picture than anything's around elsewhere. And so really it's being flocked to, quite frankly, as it gets rolled out into new markets. The blue sky in the firm is not just the imaging, but the therapy. So if they actually increase the dose of the radiation, then they can actually start to address the cancer in the body in the right location. And so they're looking at the trials going on there. So this is a biotech stock.
So
yes,
it's a multifunctional.
Yes, it is for a number of cancers. Yes, not every cancer, but for a number of cancers. And so while this stock was attracted to us because we could actually see that the management had taken the intellectual property of this business out of the bankruptcy of another biotech that was looking at something else, which this was a byproduct of, and that actually done all the trials on humans for the therapy, for the imaging, and they were successful, but they weren't related to the actual major product that this other company was doing. Therefore, those trials wouldn't satisfy the regulator. But we knew the product would work for imaging, and so that's what got us interested in this company in the first place, and it's done wonderfully well for us.
Can we talk about the macro environment for a moment? You're a bottom-up stock picker.
Yes.
How does the macro environment play on your day-to-day operations, if at all?
Yes, well, generally, we're prepared to assume that the situation is normal. The economy is just going to tick along. Sometimes it'll be a little faster, sometimes it'll be a little slower. But there are times, obviously, when things are a little bit more extreme. COVID was such an extreme. Obviously, it was as it was occurring, and the bounce that we got out of COVID. That bounce really isn't over yet. The governments have provided an awful amount of stimulus to try and get the economy, keep the economy on track. And the central bankers have been extremely dovish in order to suppress interest rates at the short end and at the long end in particular. So it's not a completely normal situation, but it's very hard to see how they're going to change their view in the short term. Now, full cycle, as the economy starts to pick up, the central bankers will back off and start to raise rates. Typically, they raise them a little too late and they're playing catch up. And while the equity market enjoys itself and has a run, at the latter stages, they're still raising rates just as growth is slowing and then the equity market rolls over. Right now, though, it's sort of being supercharged because they're still suppressing rates, even though they're seeing extremely good growth and they're jawboning themselves into not raising rates. So we think that they're going to be even later than usual to raise rates this cycle. So we're going to see even stronger growth out of the companies in the share market, probably even stronger price appreciation, but the day will come when they have to start raising rates quite considerably relative to where they are at the moment, and the share market will have a real pullback.
So that's when you start looking at shorting, I presume.
Well, it's easier to find shorts in a situation like that. Every time we do a short, though, it's stock specific. So we need to find a company that something's going wrong for, but in a stagnant economy or a recession, obviously it's a lot easier to find companies like that.
Can we turn to the objective of the fund? The objective, as I understand it, is to make more than 10% per annum over the cycle. and you've been successful in doing that so far. I think your average return is 12.7% per annum in over nearly a decade. How do you get those sort of figures?
Yes, double digit after fees. Well, with the hurdles that we put on the companies, more than 60% payoff every time we invest in a stock, and the being so selective as we are and having a relatively concentrated portfolio, we typically would have typically between 15 and 20 positions in the portfolio. It does go above and below.
What's the maximum of any one?
We don't put a maximum on it because everything we do is an outcome. If we can find more, we'll do more. What we won't do is, if we're finding few, we won't increase their weights to soak up the cash that's in the portfolio.
You'll stay in cash.
We'll stay in cash. If there's fewer, we'll tend to have more cash. That having fewer in the portfolio is probably telling us something. If it's harder to find opportunities, it's probably telling us that the market's a little bit expensive. We don't go from a top down trying to pick that. It's more of a bottom up outcome. So the way we've gotten our double digit return is to have these high hurdles when we go to invest in things, and there's that automatic protection of cash. So COVID was a great example. The fact that we were happy to sell companies or short companies that we saw were having real problems and not have to run out and find something else to invest in meant that as the market was falling, we were less exposed to that fall. Then, when the market was down, we could see lots of opportunities. We were happy to spend all that money. There were no constraints around us not spending that money, and we were able to enjoy the uptick in the market.
Was it a once-in-a-generation opportunity, that COVID fall off a cliff?
I'd say it was a once-in-a-cycle opportunity. So it seems that the markets tend to have a crash every 7 years or so. Sometimes it's a big crash, sometimes it's a small crash. We didn't see a big crash after 1987 until the tech wreck in 2000. And then we saw another big crash not long after that in 2007 with the GFC. Then again, the market's muddled quite a long time after the GFC, and then we've just had a big crash in 2020. But it's generally, you do get some sort of correction or crash every 7 years or so. And we've sort of had ours. Some people are still very bearish. I just think it's been so recent since we've had the last one. We've got quite a few number of years before the next one will come.
Part of the new format that you're managing, the MAAT, you're offering or promising or targeting a 6% per annum dividend or distribution with a paid quarterly, so it's to 1.5% per quarter to be paid to investors. How difficult will it be to achieve that? And if things are going tough, will you have to eat into capital to do that?
Yes, it's a 6% per annum yield as a minimum, paid at least 1.5% per quarter. And you're quite right. It's the potential is that we will have to pay some of it out of capital in a year where there's no income or net realised capital gains to distribute. But we're able to do that as a trust, and we think that's a great feature of the trust itself. Trusts have to pass on all income and net realised capital gains, and that's fine because people are finding it very hard to get a yield at the moment. So if we can give them a regular quarterly yield, rather than them having to go and generate that themselves, I think everybody's happy.
What's the bigger attraction for investors, the 10 double-digit target returns or the 6% actual distributions, or is the combo of both?
Well, we've got a lot more control over the distributions than we do on the returns from year to year. So I think it's a combination of both of them. Being with a fund manager that's got a track record of a differentiated style that's delivered now over 9 years through a whole of a market cycle, through both the bull and the bear, combining that with a very healthy yield that they know that they can rely on every quarter.
Well, finally, where do you position your offering in the average investor's portfolio or an SMSF? Where do you expect or pitch to investors this particular offering that you have, which is quite unusual in a lot of respects?
We see ourselves as a satellite within their Australian equity exposure. I say that because our portfolio typically doesn't hold, the BHPs and the Rios and the banks and the insurance companies and the Telstras. They can get that from a very low-cost index based ETF. But the investors are not the clients are not in a position themselves to have the same sort of insights we have from a bottom-up perspective about what's going on in the market. So if they have a portion of their Australian equity exposure with us, the composition of our portfolio will change as the opportunities in the markets change, and we're able to provide that for them in a way they can't do it for themselves. In particular also, we're able to short stocks that they can't do themselves. We have a turnover in our portfolio. It's generally about 150% per annum. It's quite a high portfolio turnover by the standards of somebody who's perhaps looking after their own superannuation fund. They wouldn't be in a position to be able to make sensible decisions with that much turnover. But this is our bread and butter business. We're looking at stocks every day and valuing them every day against the current share price.
Simon Shields, thanks very much for talking to us today.
Thanks, Peter.